Hey, today we're going to just talk a little bit about investing generally and some questions I was getting so far this year. The S&P 500 is up. This is basically the end of May of 2023, but it's a market that is being led by just a handful of tech names. So it's not a lot of what they call market breadth. So I'm just going to talk a little bit about that and why I kind of don't trust what this market's doing. If you want more economic factors in what I'm seeing, please look at a previous video that I put out there. That'll give you more kind of big picture macroeconomic stuff. But for right now, I'm just going to talk about the stock market. The other big question I've been getting from a lot of clients is, there's now AI ETFs out there. Should we do that? What AI companies should we invest in? I'll just talk about that real quick. So let's jump right into some screens and then we'll get rolling. So the big thing, this gives you kind of a view of what the markets have been doing, the S&P 500 has been doing this year. So for the most part, if you take out the 7 names that are up there, Facebook, which is now called Meta, Amazon, Apple, Microsoft, Google, Tesla, NVIDIA, those stocks, especially NVIDIA, have been on fire. They're up 44% this year. So if you look at the S&P 500, it's up so far this year 10%. So it's off to a good start, but it's basically just those names that are carrying it. If you look at the other, 493 companies in the S&P 500, they're up fractionally so far this year, 1%. So it's been a weird year. This year is the opposite of last year. Tech did poorly last year. This year it's doing great. In fact, the NASDAQ itself is off to a really good start, one of the best starts it's ever had, including 1999, including 2009, another period where it sort of took off. So, what's really going on here? And I think the big thing is we kind of got the animal spirits back in a little bit. We've got people jumping into these hot tech names, and especially the new sector is artificial intelligence, the AI. So there's a lot going into that. So this shows you a little bit of the amount of money flowing into tech. It shows it in billions, but it also shows it like a 4-week moving average. So you can see everybody's jumping into tech right now. So are the valuations changed or not? And that's what I wanted to sort of talk about here. I've got a lot of clients like, why aren't we going into tech? Why aren't we jumping into this? Well, it's because you have to ask yourself, are you investing or speculating? Now, I could try to buy NVIDIA and hope I could ride that thing a little bit higher, but I'm not really investing with it. And let me explain a little bit why. So let's compare what's going on right now with the top names in tech compared to what happened in 1999, the internet bubble. So the internet bubble, when it finally burst, many of the tech names that you see down here at the bottom, many of them lost upwards of 90%, between 70 and 90% for the most part for the tech companies. So that's what they saw happen to them after the bubble burst. Now, the top part of this chart shows you the top 7 for today. And the key thing to look at here, it's not the value of the companies per se. What it is look at the percentage of their valuation relative to the gross domestic product, which is essentially the entire economy, entire U.S. economy. So what it's saying is in 1999, the top 7 stocks essentially comprised, they equaled up to 23% of the GDP of the entire economy. So, when you have 7 companies that make up their market capitalization makes up almost a quarter of the entire economy. And remember, the entire economy isn't just publicly traded stocks. The vast majority of our GDP is driven by small and mid-sized companies. So you can see this just got a little bit extreme when it got up to almost 24%. Where are the top 7 today? It's almost 40% of our GDP. Their valuations are almost 40% of our GDP. So if you thought that it was a little bit skewed back in 1999, you got to be thinking it's really skewed today. It's even worse, almost by a doubling. So you have to actually ask yourself, like, are these companies really worth what you're talking about? And the thing is with the market right now, it really is just a few handful of companies that are leading this. This is a very good analyst that I follow, Thomas Thornton. And he's trying to show you that there's a lot more companies making a 20-day low than there are companies making a 20-day high. And so it's saying that there's a very small handful of companies that are driving the market right now. And that's pretty dangerous. Now, getting back to investing, what are you doing when you invest in a stock, in a company? Well, what you're buying are future earnings. So when you buy a company, you're looking to get their earnings into your pocket in the future. So obviously, you want to pay as little as possible to get those earnings. If you think about it, say like my company, if you go to small companies that sell typically, you might find things go for about 2 to 2.5 times gross sales and maybe 5 or 6 times profits, one or the other. They really look at those numbers, and that's all ballpark. But that's what you would pay if you were going to come in and buy my company. You might look and see what my revenues are and say, all right, I paid 2.5 times that, or look at the bottom line profit. So if I'm not driving much profit, you might say, oh, I'm only going to give you 5 times the profits. And the reason is if you buy my company, you got to make money on it. You can't just pay an exorbitant fee and never get any kind of investment for your invested capital. You just can't do that. So you have to set a valuation where you, as the purchaser of my company, are going to get some sort of return here over the next few years. And it's no different for the stock market overall. So when you're buying a company, you have to look and see, well, how long is it going to take for me to start getting some of my money back? Now, there's a couple different ways you want to look at it. Obviously, if you're buying future earnings, then there's the thing I always talk about is price to earnings ratio. So you take the price of the stock and you divide it by the current earnings. Now, if you look at some of these companies, the big ones that are driving the market right now, some of the valuations based on price to earnings are just outrageous. I mean, Amazon's at 292, NVIDIA at 215, Tesla 59, Netflix 42. Google's a bargain at 28, and then the S&P 500 overall is about 24, mostly because of these companies that are driving that. Historical average for the S&P 500 is roughly 15, although that's all variable. So you just have to say, all right, well, what does that really mean? What does a price to earnings mean? Again, getting back to my example of buying my business, if you paid me 5 times my earnings for my company, in theory, what it means is the first 5 years, you're basically going to give me all the earnings. So you're not going to really make anything until year 6. So that's sort of what you're looking at. In this case, when you're looking at this stock, say Amazon at 292 or NVIDIA at 215, what it's saying is when the purchase price that you're at now, it's going to take you 215 years just to get to break even based on earnings. Think about that. 215 years just to get to break even. Now, a lot of people say, well, they're growing like mad, and that's true. That can affect the price to earnings. So it won't actually take 215 years to get your earnings back if earnings are accelerating much faster than the norm. But still, how fast is a company that just reached almost $1 trillion in market valuation? They can, think about that. The largest company, Apple, is just over 2 trillion. So even if they double and their price to earnings goes to 108, but now they're the biggest company in the world. I mean, how fast can they grow? It doesn't make a whole lot of sense. So you've got to look at that. But the one that's really interesting is price to sales ratio. So sales just means revenue. So if you think back to the example that I gave you for my business, if you pay 2 or 2.5 times revenues, again, based on those revenues, it takes you 2.5 years to start actually having revenues of your own. Price to sales ratio for NVIDIA is 40. Microsoft's 12, Tesla's 8, Apple's 7. Overall, the S&P 500 is about 2.4. Okay. So, that's just gross revenue. That doesn't even get into expenses. And I want to just talk a little bit about this quote. This is from the CEO of Sun Microsystems back in 2002 after the internet bubble had burst. And he was talking about 1999. So this is a couple years past that. And this is a hard slide to read. I apologize. Either you can pause the video, but I'm going to read it right here to you. So this is who was the CEO at the time of Sun Microsystems. He says, and I quote, 2 years ago, we were selling at 10 times revenues when we were at $64 per share. At 10 times revenue, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. Again, it takes 10 years just to get your money back. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividend, which is kind of illegal. And that assumes with zero research and development for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? So that is what Sun Microsystems CEO said back in 2002, which was a couple years removed from when his company reached 10 times revenues, just 10 times revenues. And again, I'm going to jump back to this. Look at the bottom of this chart, price to sales, so price to revenues. So Scott McNealy, who was the head of Sun Microsystems, was saying at 10 times price to sales, you were a ridiculous investor for putting your money into it. Now we have NVIDIA at 40, Microsoft 12, Tesla at 8, so on and so forth. So do you think it's different this time? That's what I'm asking you. I don't know when this thing is going to kind of falter or what, but you're not investing at this point, you're speculating. You're just hoping you can buy into this because it's hot, and you're hoping you can ride it up a ways, and you're hoping that maybe you can sell it before it starts to come back down. But if you look at my other videos talking about the economy, well, unemployment still looks very good. The rest of the leading indicators in the economy are heading south, and they're heading south quickly. So even if we don't go into recession, if things stay slow, how are these companies going to grow their revenues that quickly? And an interesting note on NVIDIA is, as soon as their stock really started to explode here recently, they then put out another prospectus to sell another 10 billion of stock. So they're they're selling more to the public. Obviously, the public wants more NVIDIA, so they're going to sell more at these prices and get some cash reserves. Now, it's probably very smart from the corporate side to do that. So you have all these people that are willing to pay 40 times price to sales or 40 times revenues. Why not give them more stock? And then they can load up on cash so that if things get a little difficult, they have some reserves here. So, but as an investor, anytime a company is selling more stock, that's usually not a good thing. It dilutes the shares you already own at a minimum. But sometimes it's also endemic of a company that's sort of hurting for cash. But I don't think that's the case here. I think it's more the case that they see this ridiculous stock price and they're like, why not make some money off of it? So they're going to sell to the public who will lap this stuff up. And then, they'll have a nice little cash reserve. Okay, so the other big takeaway leads into the next question that I've been getting is, how about AI stocks? So AI stocks are hot, and that's why NVIDIA is doing so well, because they produce microchips that are involved in AI. But NVIDIA got hot when they were producing chips for all the different blockchain technologies, the Bitcoin, Ethereum, all of that. So it got hot then, and then it faded a lot last year. And now it's hot again because AI is hot. So again, going back to 1999, the internet stocks were really hot. And then later down the road, it was real estate that got really hot. And then it was, we had marijuana stocks really hot. We had crypto stuff really hot. And right now it's AI. Now, it's not that these aren't good companies. I mean, the internet obviously changed the world. I don't know about marijuana stocks per se, but definitely I think blockchain and crypto is going to have a big impact in the world. And so is AI, obviously. But there's going to be a washout for it, just like there was for the internet stocks. Many of the internet stocks, when that bubble got going, became became really overvalued. Ludicrously overvalued. There we go. So they became just extremely overvalued. And eventually, when rates went up, the internet stocks got hammered. And what's interesting about this rally is typically tech doesn't do all that well when interest rates go up because consumers demand earnings. If you can go out and get a T-bill at 5%, well, then you want to make sure that the company you're invested in is delivering earnings to you. And it's even more potent when you're talking about inflation. If your dollars are losing value due to inflation, you need more dollars. So you need actual earnings. So, I don't know why tech has taken off like it has, other than NVIDIA, being AI, and AI is really hot. But when you look jumping back, when you look at these sectors, I think you need to let the shakeout happen. So you need to let a lot of these companies kind of fall by the wayside, and then you'll start to see which ones are really good. Just like you did with the internet bubble, and what you're still kind of seeing with crypto, like what's really going to work. A lot of the crypto stuff just is gone. It's never coming back. So, I would hold off on any kind of AI investing right now just because you're not investing. You're just speculating. It's a hot sector. You want to get a piece of it. You've got that FOMO if you're missing out. Just don't do it. Don't do it. And the market overall right now, well, it's up. It's being led by just a handful of tech names. It's not a very healthy situation. So a lot of the factors I'm looking at right now are still kind of telling me to stay on the sidelines. I still like international. It's really cheap, and you can get high dividend internationally. You can get things yielding over 5% internationally with a low price to earnings. I also still like value, although value is down for the year. I still like energy stocks, and we had energy early in the year, and it really kind of hurt us. But when you look at the cash flows and the earnings that they're driving, it's phenomenal. So my big thing with the questions from AI and the questions on tech and the questions on, when are we going to get into tech? Just give it some time here because it's really dangerous. So been through this rodeo a few times now, and it always kind of ends the same. It always does, and it doesn't end very well. One last thing I'm going to address is just now that the debt ceiling is done. If you look at previous video, I basically said it was going to be a nothing burger, and it was. It was all just political kabuki theater. Everybody, all the politicians, look at me, look what I'm doing, I'm so good. That's all it was. but I am not too happy with the outcome. Basically, we're guaranteed to go $4 trillion more in debt before the next election. So I don't know. I feel like, people saying, oh, we're going to slow spending, stuff like that. I feel like you're picking up pennies in front of an oncoming high-speed rail train. You may think you're making some money there, but you're about to get run over. So anyway, that's what I just wanted to quickly address a few of these questions. And keep the questions coming. I'd like to address all that stuff for everybody. So take care.